Hello, and welcome to today's Environment and Energy Leader webinar titled Affordable Storage and Clean Energy, How Financing Enables Zero Capital Projects, sponsored by Enel X. My name is Jessica Hunt, and I'm the Director of Events for E&E Leader. First and foremost, thank you for being with us today from wherever you are in the world. In case you are watching this on demand, it will be available by Wednesday afternoon. If for some reason you have technical issues during today's event, please follow the troubleshooting tips at the bottom of the console. And if you are still having a few issues, feel free to send me a message via the attendee chat or the Q&A widget. Attendees do have the ability to chat with each other during the event. Say hello, let us know where you're joining us from and why you decided to jump on today. And Enel X was kind enough to offer the slide deck to all attendees, as well as a couple of additional resources. And just like always, we will have time for Q&A at the end of the presentation. So if you have questions for the presenters, please submit over the next 40 to 45 minutes. It gives me great pleasure to welcome two experts from Enel X. We have Willie Homza and Andrew Lessard. And at this point, I'm going to turn the presentation over to them, and I'm going to rejoin everybody for the Q&A. Thanks for being here with us today.
Thanks for the introduction. Greetings, everyone. I'm Andrew Lessard, and I will be one of the presenters here. You can see my background on the screen, but just to provide a little bit of color to that, I started with Enel in June of 2020. I've worked with in customer-facing roles for quite a long time, and I started in energy in 2011 with one of our national suppliers here in the U.S. Here at Enel, I do work with our key account relationships, hence the title, Key Account Manager. But we have a complex organization, lots of different delivery solutions that I work across. And so we have a customer-centric team in the middle that I am a part of that helps to kind of manage our delivery solutions with our customers that are working across many of those silos. So I'm excited to share with you the information today and present with Will. Will, you want to give us a quick introduction?
Yeah, thanks, Drew. So my name's Willie Homza. I'm a solutions engineer with Enel X. I work mostly with standalone storage and solar plus storage opportunities. Try to understand how each of these solutions can provide the most value for customers. I've been doing this for a little while now, but prior to this, I worked in consulting roles, working a lot with utility programs from just demand side management. So looking a lot at energy efficiency and demand response. So a lot of things relevant to DERs. So yeah, very excited to dig into this with you all.
Cool. So we're both going to be presenting different parts of this. Obviously, I'll be taking the reins here first. And before we jump into the meat of the presentation, I just want to put our view on these solutions in context by sharing a little bit more about who we are and what kind of company Enel is. I'm sure some of you are familiar with us, but for those who aren't, just to put us in context, because we're not necessarily a household name in every instance. And starting with some of the things that we've been hearing with our customers here. So on this energy trends slide, or trends in energy transition, excuse me. So these are some of the things I've been hearing. These are from some of my colleagues as well. And really the underlying message of this slide is that we're just seeing a lot more conversations about net zero goals, carbon reduction, and just urgency around making decisions that ultimately lead to the third column here, the market resiliency. So just being a more resilient business is an underlying outcome that businesses are seeking with some of our help. So from a climate change risk trend standpoint, 38%, you see that on the bottom, that's a year old. That's probably a little bit higher now. That number was only really less than 10% in 2017 from the Fortune Global 500. And as a result of that growth in that group of customers, that group of companies, there's a lot of waterfall effect down to the tiers below it as well. And I'm sure a lot of you are feeling and seeing that in your own companies. From a stakeholder influence standpoint, that's where some of that change is coming from. You see this quote from Larry Fink, BlackRock CEO. This was from the Q2 22 earnings report, so just came out. But I think the phrase that sticks here for me, and the one that he's been sticking with for quite a while, is just climate risk is an investment risk. That investors, that board members are looking at sustainability not just for the environmental benefits, but really as capitalists and as a way to protect their investments. They want to see their businesses be more resilient to the effects of climate change on the global economy. And then the last one is the benefit of resiliency, really within the context of a lot of market volatility right now. So in the last year, we've seen natural gas pricing, which is an underlying driver of our electricity costs here in the United States, range from $3.40 all the way up to $7, even higher if you look at spot pricing. And in the prior 6 years, really a range from only $2 to $3.70. So just a massive amount of volatility, particularly in the last 5 or 6 months, and that has changed the perception of renewable energy investments and goals toward carbon reduction, because those investments are being viewed as less risky in comparison to some of what the volatility we're seeing in our brown power markets. Just to introduce us a little bit more, and we'll get off of this topic in just a moment, but I just want to put our company in context a little bit more. So we are first and foremost the poles and wires in a lot of countries around the world. We're based in Rome, so that's where the 75 million users are coming from. Globally, we have the largest private capacity of renewables, so 53 gigawatts currently. We're investing aggressively across the world, and in North America in particular, where we're going to see 154 gigawatts by the end of this decade. We have 4,500 North American businesses, so we are a B2B company here in North America, and then we're the global leader in demand response programs around the world. So just to put that in context, we're not a startup company. We are not a growth company. We're a healthy, large global organization that is partnering with companies of all sizes. These are some of the solutions that we offer up and down the menu. So whether it's flexibility solutions like demand response or battery storage that are plays at for financial benefit, help with grid reliability, things like that, or roadmaps towards decarbonization. So we have on-site generation capabilities, and also off-site renewable energy contracts that we can offer, a variety of those where there are virtual or local physical power purchase agreements. So just kind of giving you a little bit of a sense of who we are there, and now we'll jump over to the agenda. So we're going to talk a little bit about what these types of projects look like from a finance standpoint, how companies could go about that, and then what the value drivers are and the reasons to go into those projects. I'll be covering those two sections and then turning it over to Willie, who's going to talk about specific use cases. So an standalone energy storage project, a solar and storage project together, and then a standalone microgrid solutions as well. And then we'll leave plenty of time for Q&A. I know there were several questions in advance. Thank you for all that in advance. And we'll try and pepper a couple of answers into the presentation as we go. So first of all, how the financing enables these projects. So 3 options, and I want to focus on the first 2 columns at the onset of this slide. If you wanted to invest in a battery solution or a solar solution on site, you can direct purchase that out of your CapEx budget, or you can go out and get a loan and attach to that project fixed loan payments. In that case, you're really, as the company, taking on all of the associated benefits and risks with the project. And so specifically speaking to those a little bit in more detail, the value. So I'm going to get into value drivers in the next section, but the value streams that come out of that. So whether that becomes, energy flexibility to try and optimize your electricity costs, or programs that you can participate in, or rebates, whatever those things are, you're going to capture all of, or basically most of, with the loan option, those value streams. On the other hand, from the risk standpoint, those value streams, when you make a decision today, that's a 15-year or 20-year or 10-year decision, those value streams are based upon a set of assumptions, right? So you're going to make a decision, a financial decision, based on what you think will happen in the future with those value streams in order to claw back your initial investment and obviously exceed that and have a benefit. But the market dynamics can change, right? So those performance risks and those financial risks are completely on the customer's shoulders, really, when you are direct purchasing or third-party financing. If the assumptions go the wrong way, you have borne the risk by putting the capital up front. So then, looking at a no CapEx option where you're partnering with a developer, what that really looks like is, yes, no money up front. You're getting a battery solution, a solar array, a combination of the two on your site from day one. But as the project unfolds over the next 10, 15 years, the value streams that are created by that project are shared with the developer. That's how they get their investment back over time. The value streams are always split along the lines of the agreement, whether or not those value streams do come to fruition. So from the performance and financial risk standpoint for the customer, the risk is very low. The risk is shifted over to the developer who's put up the cash. So that's where we really begin with when it comes to creating the value stream, or creating a financial option out of this in a partnership. When we look at that, look at those on a timeline just to visualize it, just an example of a 20-year customer cash flow, you'll see these orange bars are really representing a direct financing option. There's an initial investment where you're going to come out and you're going to be in a negative cash flow scenario up until a certain point where the value streams that you've created from that asset are going to accumulate enough to have exceeded the initial upfront expense. And then, of course, you're going to grow that value over time. With the purple bars, developer financing, you're never going to be in the red. You're always going to start from a point of accumulating value over time, but you're going to be sharing that value, as I said before, with the developer, so that you're stacking that value over time, but some of it is being sent out to pay for and split with the developer. With this diagram, I just want to describe a little bit what this looks like when you insert a developer into it. When you insert a developer like Enel X with a distributed energy resource, like a solar and storage solution, into the traditional relationship that you have with your utility company. So the first thing that happens here is that you're going to sign an agreement. Maybe it's a fixed power purchase agreement for cost per kilowatt hour, or a benefit share agreement with a developer. At the same time, the developer is going to completely out of pocket pay for that asset to be put onto your site. The second thing that it doesn't necessarily happen sequentially, but the next thing that does happen is that the DER, the distributed energy resource, will be used to create those value streams. So that might be a demand response program. I'll describe that a little bit more in detail in a moment, or sort of discharging a battery at certain times of the day in order to offset electricity costs. Whatever those value streams are, it will be utilized for the site and offset some of the power consumption. Meanwhile, the utility and the energy customer are going to continue to have the same relationship they had before for the residual power. If the solar array isn't going to produce, 24/7 power availability, which it almost certainly won't. And then you'll still have your traditional bill. For any grid-based incentive programs like demand response, those checks are going to come into the developer that is running those programs on your behalf. And then lastly, there is a reconciliation process. So there's essentially going to be what would you have paid without this asset existing on your site? What did you pay? And that difference is going to be considered the value of the asset and then split according to the predetermined benefit share contract. Or there's going to be a handing exchange of money based on the power purchase agreement as well. So there's some reconciliation between the two organizations. So that's kind of how we see a developer be inserted into this relationship where it would have just been utility to energy customer vertically there. So to unpack those value streams, I just kind of alluded to a couple of them there. On the one hand, you have bill savings. On the one side, I put bill savings and peak reduction on one side, and I put demand response and incentive earnings on the other side. And the left-hand side of this slide are really about looking at the utility structure, the way that your utility rate is charged, the kind of the rules and tariffs that determine that rate, and unpacking it and understanding how can you best optimize the way that you use power and use an asset that gives you flexibility to reduce that amount of money that you're spending on electricity as much as possible. So you're really optimizing the cost, and you're taking advantage of the way that the tariff is structured, and you're doing that in a way that the utility wants you to do that. It's incentivizing. If the utility puts a lot of cost on one component of your electricity bill, it's because they want to incentivize you to try and reduce that as much as possible. So that's what these assets allow you to do. On the other hand, there's just flexibility programs like demand response, or there are state and local rebates that you can take advantage of that create other value streams as well. So let's take a look at both of those things a little bit closer. First off, from the kind of playing with your power usage and time of use and what's going on with the tariff, there's really two parts of your electricity bill. If you haven't really unpacked it before, I suspect lots of folks on this call may be intimately familiar with these components, but really you're paying for the energy that you use when you use it. Those are your energy charges. When you take a look at those, you're going to have on-peak usage in a lot of markets and off-peak usage. You may be in a market that is just real-time usage and it's averaged out based on what you actually used. But a lot of markets have on and off-peak rates, and what that means is during the middle of the day, that is when a lot of customers are using energy. Those are the on-peak hours. Those typically are more expensive kilowatts. Versus off-peak, which is middle of the night type of thing. So those charges, you can look at a battery, and if for example you're in a market where there's real-time energy charges, you might see cost thresholds where you want to discharge your battery if the hourly rate of electricity is more than such a dollar amount, because that would be an opportunity to use your battery rather than paying an excessive amount for your hourly consumption. So that's an example of creating a value stream from the energy charges. On the other side of the bill, we have demand charges, and you can think of demand charges, if you're not familiar with that, is that we all collectively, for each meter that is out there, we all pay a little bit into a pool of money to make generation assets available 24/7, 365. Whether or not they're being actually turned on to create power. So you might think of a peaking power plant, a natural gas power plant that is really used during the hottest days of the summer or the coldest days of the winter, when everybody's trying to heat their homes in the Northeast. That power plant is ready to turn on 365 days a year, but for the limited number of maybe 40 hours a year that it's running, the energy charges that would be charged based on the power it produces would not be enough to keep that plant running. So there's this other pool of money called demand charges that pay that plant to just be on call for all of the days of the year and all of the hours of the year. We all pay a little bit of that, and the charges that are doled out there are calculated by looking at what each meter uses during peak hours on the grid. So when you try and unpack and strategically and optimize your costs around those charges, it means trying to guess when those peaks are calculated and completely taking that meter down to zero during when we expect those peaks are being calculated, and using a battery asset to do that. So you can sort of optimize this down to a zero charge if you're really tuned in with some good forecasting software and a flexible asset like a battery. On the other side, I talked about these sort of incentive programs and revenue programs. Demand response is something that we're very familiar with here at Enel. As I said, we're the global leader in demand response. So we use programs like this all over the US and Canada. You can see all the markets that they're available in. And what they really are is that, I was talking about those peaks, each customer has the opportunity, business customer has the opportunity to participate in these markets where you're offering up some of your load, the typical usage that you have during the day, and nominating it, making it available in a program where the grid operator may use the aggregate of all those nominations to rebalance supply and demand. So rather than maybe calling that peaking power plant that I talked about to turn on to meet a supply and demand imbalance, they may call this program and take demand off the grid rather than adding more supply in order to rebalance supply and demand. So it's a program that does basically pay you to make your power available for curtailment, and occasionally will, depending on where you are, occasionally will call you to actually show up and do that curtailment. And so with a battery, you can make a lot of your power available for curtailment, and then therefore create a value stream from programs like this. In summary, and I'll turn it over to the specific use cases with Willie here in just a moment. I talked about the bill savings and the peak reduction from solutions like these on the left, those sort of optimization strategies, and then the demand response and incentive earnings. Those incentive earnings are, I'm not going into those because they're so market specific, but there are rebates and incentive tax credits that become available with projects like these as well. But Willie is going to take over here and talk about each of the three use cases on the left here, the standalone storage being the first one. So yeah, why don't you take over, Will? Thanks.
Great, thanks, Drew. Yeah, so as Drew described, I'm going to take a look at standalone storage, solar plus storage, and then also a few things beyond that, a little lighter touch on those. So starting with standalone storage, what I want to do here is describe the value proposition that this provides for customers, how it expands upon traditional flexibility that Drew described sort of through demand response, and then also describe how the no-cost financing works for energy storage specifically. So let's get into it here. So there are a variety of priorities and challenges that customers could be facing that standalone storage could be well positioned to solve. So a few of these revolve around operational costs. So if a customer is looking to reduce operational costs, in particular, if these costs are due to energy bills that make up a large portion of their operating expense stack, storage could be a solution to this. And then finally, from like more the financing perspective, if you're a customer with limited access to capital or just a risk-averse nature in terms of high CapEx investments, especially in industries that may not be scoped around your business, then the financing model in particular would be a good pathway to gain access to the benefits provided by storage. So now hopping over to the right side, let's think about how storage expands the benefits beyond traditional flexibility and demand response. So the first is operational continuity. So let's think about traditional demand response. In traditional demand response, what a customer is really doing is just reducing their demand from the grid by manually or automating a shutoff of a portion of their facility. So any non-essential loads is the most common approach to this. You can shut down non-essential loads and get paid on a dollar per kilowatt basis for this reduction. When we talk about incorporating storage to provide this flexibility, instead of truly reducing the consumption of your facility, all we're doing is, instead of purchasing electricity from the grid, we're using electricity stored in your on-site battery. So this enables your facility to continue operating unaffected while providing flexibility benefits to the grid and also monetizing these. So that leads to the second one, which is revenue potential. If we look through a demand response lens, the way that you monetize this is based on your kilowatt reduction in demand on the grid. So traditionally, this would be limited to the amount of load that is economical for you to shut off. So let's say a portion of your processes at your facility or organization can be shut off, and the value of the DR exceeds that. With the battery, because there is no operational impact, you're able to use effectively the whole capacity of the battery to respond to demand response events, which reveals a significantly increased revenue potential that you can bank on. And then finally, expanded capabilities. This is what I think is the most exciting nature of being able to leverage resource that's dispatchable in real time, that we can adjust the dispatch strategy throughout the day, depending on market signals, weather, etc. So by having a battery asset that you can ramp up and down in terms of dispatch or in terms of charging and discharging, we can have a much more complex load adjustment process that reveals and enables access to more revenue streams. So that is where I want to dive a little deeper into now. So let's take a look at the right side here. What we're looking at is an example load profile for a customer over the course of 2 days. So this is the electricity draw from the grid in particular that we're looking at. The gray line is what this customer's demand on the grid is before installing and managing a storage asset. The purple line is the result of installing a storage asset that is then optimized around a few savings and revenue streams that we'll talk about here. So first, let's talk about demand charge management. So this is a bill savings mechanism that addresses demand charges as Drew just described. So a customer is charged based on their peak demand over the course of a month. So if we're able to target these peaky hours throughout the month, we can really reduce and make a pretty significant impact on this portion of the bill for a customer. So in this example, what we're doing is we're understanding where this customer is peaking across this 2-day period, and this extends out over time as well, but this is just a specific example. What we're doing here is when the demand gets over a certain level, we start to use the electricity from the battery as an alternative to buying from the grid. So we're reducing the demand by sort of the vertical height of that sort of orange or pink triangle you're seeing there. The second savings mechanism is, rather than a demand charge, an energy charge. So this is $1 per kilowatt hour basis. Effectively, what we're trying to do here is, if there are different tiers of pricing, so say in the morning you're paying 3 cents a kilowatt hour for electricity, and then in the afternoon it goes up to 10 cents. What we're trying to do is charge the battery when cost of electricity is low and discharge it when it's high. So really what we're doing here is a customer is consuming the same amount of electricity, but we're buying more of it when it's cheap and less of it when it's expensive. So that delta there reveals the bill savings that we see with energy arbitrage. And then finally is a revenue stream, because I say revenue rather than savings because this is the result of a service we're providing to the grid. Demand response is the primary one that I'll give an example of here. So if we look in day 2, we can imagine a demand response program where, let's use an example where we know that this utility has called a DR event, say 12 or 24 hours in advance. We know that by reducing customer demand during this time, we will get paid a set $1 per kilowatt amount. So our battery strategy throughout this day is we can continue to reduce demand charges as we're seeing in early day 2, but then we want to make sure we have a fully charged battery at this time. We can dispatch it fully, reduce load significantly, and lock in that dollar per kilowatt value that will be paid out as a result of this demand response event. Last thing I'll mention here is that all of this is being done while operations continue unaffected for the customer. So this is all happening in the background, and you're really just getting bill savings and revenue generation as a result. So all of these concepts are relevant in most markets, but in some markets, they're more lucrative than others. So let's check out the characteristics, what makes a good project, and then sort of where we're seeing some of these characteristics across the US. So on the left side here, these are a few things to keep in mind that generally indicate that a standalone storage asset could provide substantial value to your organization. So the first two are related to your load profile, your actual demand from an electricity perspective. So larger loads generally provide more savings opportunity than smaller loads. This goes back to if energy or electricity costs make up a large portion of your expense stack, it'll generally have a higher impact on your business overall. So if you consume a lot of electricity, it's worth noting that a solution could be there for you in the form of storage. Second is spikier loads. So what we mean by this is that if a customer has a consistent consumption throughout the day, there are a few things we can do to try to create savings, whether that's energy arbitrage or respond to demand response events. But in a case where, say, a customer consumes a lot of their electricity just over the course of 2 hours of the day, we can really target those 2 hours with the real-time dispatchable storage system and have disproportionate impact on your bill, specifically demand charges. So that's another thing to keep in mind. It really depends on your facility operations. That leads me to demand charges. So as Drew was describing, if this demand charge is very high, that means the peak draw over the course of a month from your facility is very impactful. And that's something a storage system can address. So a few things to keep in the back of your head. If your demand charge is, say, $10 to $15 per kilowatt, or makes up 30 to 40% of your bill, that's something that we could target pretty effectively with a standalone storage system and could be worth investigating. The final two callouts here on the left side are a little more regional specific. So grid services programs. So we can think about demand response programs don't exist in all markets. And in markets where they do exist, some are more lucrative than others. And then finally, clean energy incentives. So some state and local jurisdictions have incentives for storage, sometimes with solar, sometimes standalone. And in areas or regions with these incentives, it makes many more business cases pencil. So it's worth knowing if in your region there are incentives available to standalone storage. So all of these characteristics, it's good to keep in mind, but realistically, let's look to the right to see where we are currently active, largely as a result of these characteristics just described. So the most established and scaled markets for standalone storage at the moment are California, with some pretty good energy arbitrage opportunities, especially with solar. Up in Ontario, there are significant demand charges. In New York and Massachusetts, we are seeing pretty lucrative grid services programs sponsored by the utilities. And then there's a couple other tiers that are emerging, establishing themselves, and some that we're pretty optimistic about in the future. So there are some PJM markets, Illinois, Pennsylvania, New Jersey. There's also some clean energy incentives rolling out in Connecticut that we're pretty optimistic about. And then PJM more generally is we're pretty excited about. And I think one thing to note here is that if a customer, or if the storage ITC that's being, that has been incorporated in this new Inflation Reduction Act that has been in discussion with Build Back Better for extended periods of time, if this investment tax credit comes through, the number of markets standalone storage could be applicable in really changes and expands. That would be a positive sign for the applicability of standalone storage across the board. So let's now look at a case study just to understand. We've talked a lot of conceptually around what we're trying to do, but I think it's useful to make it come to life a little bit. This is an example of a super exciting project we have up in Ontario, Canada with Imperial Oil. The main pain point that we are trying to help this customer address is the result of these unique demand charges that are specific to Ontario called global adjustment charges. Effectively, what happens here is that the customer's demand during the 5 peak hours of EISO, the grid operator's grid, have a disproportionate financial impact on the electricity costs of Imperial Oil and industrial customers in Ontario. So the solution we reached with Imperial was a very large 20 megawatt behind the meter 2-hour storage system that will be used to really target multiple value streams, but in particular, mitigate these global adjustment charges that they're exposed to. Just to give you a sense of how they access this, Imperial Oil is paying no money up front for the capital cost of this project. And the sticker price for an asset this size ranges between 15 and 20 and upwards $15 to $20 million for this asset. So it just gives you an idea of that this customer can reap the benefits of this asset without paying upfront. And this is through the benefit share model that Drew described up front. In this example, the benefit share is expected to deliver upwards of a couple $1 million a year to Imperial Oil over the course of this 15-year term. So it's worth saying that this is a super lucrative, very big battery project, but it does a great job of describing the financing mechanism that enables customers to pay no money upfront and reap continual benefits over the course of a project. The last thing I'll emphasize here is the partnership nature of this financing mechanism. Because Enel X benefits from optimal battery management to reap savings and benefits, and the customer receives just a portion of this, the incentives are very aligned and reveals a partnership rather than a transactional relationship. So I'll wrap up here with storage to again mention that this could be very applicable for customers with desires to reduce operational costs, those who have high electricity costs, and limited willingness to spend big bucks up front to gain access to these assets. Now I'm going to shift a little bit to talk about how the addition of solar to the storage system changes the game a little bit in terms of customer wants and needs that are addressed. We'll talk about how this addresses or impacts some of the value streams, and also how the financing is slightly tweaked based on the nature of solar. So solar plus storage addresses some of the same priorities as customers when we talk about trying to save on operational costs on the left side here with limited access to capital, but also has a few other benefits when we talk about if customers or businesses are looking to become more sustainable, solar as a clean energy resource really meets this need. And then also it provides predictable electricity prices, which I'll get into in a moment. So how specifically does solar plus storage expand the benefits of traditional flexibility, but also just standalone storage? So first is sustainability, as I mentioned. So as solar, each of the kilowatt hours produced by this asset will effectively be reducing your purchasing from the grid. And as we know, solar is zero carbon. So by definition, you'll be reducing your carbon footprint if the grid you're connected into has any carbon at all, which at the moment they all do. So you're reducing carbon footprint in a sustainable way here. Second is economic predictability. This sort of flies under the radar, I think, but the way this is revealed is a customer will pay, in this case, Enel X or developer financer, a set dollar per kilowatt hour value for all of the electricity generated by the solar asset. The counterfactual to that is if you didn't have this asset, you would be buying these kilowatt hours from the grid at the market or utility price. As we know, it's very hard to know what this price would be 5, 10, 15 years in the future. So knowing what even a portion of your electricity costs will be down the road could have significant benefits in terms of long-term business planning for your organization. And then finally, there are a lot of additional economic incentives available to renewable resources, which solar is one. So there are federal and local jurisdictions that provide different benefits for storage as well when it is specifically paired and charged by solar. So let's get into the value streams a little bit, similar to how we did with storage, but I want to show how solar changes it a little bit. So here what we're looking at is an original customer load, so the demand over the course of 24 hours on the left side of the screen. In the middle, this is the resulting demand after installing a storage asset. In this case, we can see it's actually quite a big asset that is exporting during the middle of the day. And then on the right side, we see the result of adding storage. So we can really target peaks more effectively with the dispatchability of this asset. So the energy, demand, and financial implications of this. From an energy charge perspective, we're reducing the amount of kilowatt hours that we're purchasing from the grid over the course of the year and replacing it, as mentioned before, with the fixed PPA rate. So here we can see the energy charge costs go down on an annual basis as a result of this. Now let's think about peak demand. So we can see that in the middle, solar can sometimes coincide with a peak here, but the real value out of the battery is the ability to make sure that even if the clouds come for a little bit and solar isn't producing, we can still reduce these peaks and provide bill savings in addition to just reducing the energy charges for the customer. So key takeaway here is that solar plus storage lowers energy purchases from the grid, so kilowatt hour savings, and then also the addition of storage continues to provide the savings and revenue streams that I described in the standalone section. So let's get into a case study. This is a very cool project we have with UMass Boston. In this example, we provided a fully financed solar plus storage plus EV charger project. Again, fully financed, so no CapEx for the customer. This battery is reducing the bill through demand charges, playing into demand response events in the utility, and peak shaving throughout the year. Financially, the customer is expected to save around $2 million over the course of the term. And this is a result of the 17% benefit share that we see depicted here on the bottom left of the screen. So again, emphasizing that this is an example of a school, so perhaps different incentives than a business may have, but they're able to reap significant benefits by engaging in this financial partnership over the course of an extended period of time, while not requiring any upfront capital. So to summarize solar, before hopping forward, solar plus storage is relevant for customers, again, looking to reduce energy charges, but also looking to meet sustainability goals, respond to investor priorities, and also lock in predictable dollar per kilowatt energy prices over extended periods of time. So one more section I want to get into before getting to Q&A. This will be a little lighter touch because the main point here is to describe that more innovative and custom solutions like microgrids can be accessed through a similar financing mechanism. These are not as repeatable or scaled as standalone storage and solar plus storage, but just wanted to give you a sense that this could happen in the future. And if you have very unique, specific resiliency needs, it's something that we can certainly look into. So this is an example of a microgrid project. So I'll provide a quick example of what we mean by microgrid. So when we say microgrid, we really mean a facility that can continue to operate when the larger utility grid blacks out, browns out, or has severe reliability issues. The solution we came to here in Puerto Rico is a 5 megawatt solar, 1 megawatt storage asset that works in conjunction with an existing backup generator on site to provide a more sustainable and resilient solution. So this is just another call out to say that this isn't something that needs to be built from scratch. It can add on to existing backup and resiliency solutions you already have on site and can be accessed for no capital upfront through this finance mechanism. Final thing to note here is that just because it's a microgrid doesn't mean you can't also play into revenue streams described above, whether that's demand charge management or demand response events. The difference is that we just need to require some capacity in the battery to ensure that if all else fails, there's still some power we can provide to the facility. I'm going to touch very quickly on one more that is a microgrid, so solar plus storage, and also electric vehicle chargers. This is a project with Alltown Fresh in Massachusetts. Here we're also incorporating an existing portable generator that can help support for extended blackouts, if we think days or weeks, in the fact that we're dependent on the solar in the case, if we're exclusively dependent on the battery, so the portable generator provides an additional layer of security. Again, I highlight these innovative examples to show that there's a broader range of how this no capital financing mechanism can provide solutions to customers outside of storage and standalone and solar plus storage. But again, mentioning that these are more custom and not quite as scaled and repeatable as the initial products I described. So I know we want to leave a little time for Q&A. So quickly to wrap up here, what are the main takeaways? So first on the left, who can benefit from on-site storage and clean energy projects? Customers who are looking to have cost savings, operational continuity, and sustainability could definitely benefit from standalone or solar plus storage solutions. How do we deliver this? What's our offering? The offering here is that by optimally managing this battery and solar asset on site, we can access many value streams, both savings, demand reduction, but also revenue, demand response. And by sharing the benefits with the customer, we can enable you to access these value streams with zero capital expenditure. Again, looking at this cash flow chart over time for developer finance projects. I now want to hand it back over to Drew to talk about, if you're curious about this, how to take next steps from an account management perspective. So Drew, back to you.
Yeah, thanks, Willie. The map here you're looking at, I mean, is the final takeaway. It's if you have major energy consuming sites, if you have important sites in your company that are located in these markets, take note. We'll send these slides out, of course. We'd love to talk to you about them. The subtext of this is just to keep in mind that this is a map of at the moment, right? So incentives are changing, are dynamic. If you're located in another area, I saw a question about Utah. Willie would be happy to kind of dig into what specifically is going on in Utah, as to what the reasons are that it's not a great market right now, or what the reasons, what would need to change for it to be a good opportunity and more financially beneficial with a developer financing approach. So I think whether you're in a gray market there or not, if you're curious about what's going on, we'd be happy to talk. And really, the bottom of the slide here is that point exactly, is that the next step would be, feel free to reach out on LinkedIn. I've already seen a couple of alerts on my phone here from a couple of you. If you'd like to just chat, we would be happy to take a look at your site list, where you're located, and see where we'd be aligned on a potential project. And a feasibility analysis is really not putting yourself out too far in terms of a commitment. So yeah, we'd love to hear from you. So that'd be the next step. So we'll take some questions. I saw a lot of them in the chat here. And here's our email, and welcome back, Jess.
Thank you very much. Yes, I do want to thank the audience for all of the questions that you've submitted. I think we're going to be well over 30 questions by the time we wrap up in about 10 minutes. And I know some attendees also submitted questions to me in the chat widget. If you can just move them over to the Q&A box, that would help us tremendously. So Drew, we're going to stay with you for the first question. Are these opportunities ideal for facilities with consistent loads, such as data centers, or any applications to higher ed or hospitals? And I know obviously Willie touched on the project with UMass as well.
Willie, I think that would be I was thinking that question would be good for you. I was reading it earlier, okay. And just when you were talking about those load shapes and you know, different kinds of customers with a data center, you know, really flat load. What do these look like in different circumstances?
Yeah, so I'm actually just quickly flip back to the slide where I think we try to highlight a few of these characteristics that are positive. And so I think there's two things. In the case of a data center, there's the benefit of likely a very large load. And in many cases, there's the benefit of it being okay if we shift when some of this electricity is being consumed. It may not be a process where you require 8 hours consistently of the same amount of power. So the flexible nature of data centers could actually provide a very good opportunity, especially if the scale is large. So from a larger load standpoint, data centers can be great. And also the nature of their flexible load can be positive. So that's my quick answer to that. I forget, Drew, is there a second part to that?
Sure. No, I think the other part, I mean, the other part is another question, but on the same, in the same vein, I guess, when you look at the load of a data center, you look at the load of, you know, whatever the load shape is, how do we look at how much storage we need? And I think it maybe varies by market. You know, if you're looking at the best solution versus you're looking at solar and storage, but generally, you know, that was one of the questions here. So how would you answer that question?
Yeah, I'd say if we look at standalone BESS, we're definitely sort of generally capped oftentimes at the peak demand of the customer in terms of battery capacity. There are a few markets out there where exporting to the grid is in play. But if we're talking about demand charge reduction, and that's a big part of a lot of the standalone systems we look at, the maximum size of the battery would align with the maximum demand from the customer. And then finally on the solar side, we just need to make sure that the storage asset can be fully charged from solar to reap ITC incentives and other things. So definitely a complex question, and that's part of our job is to figure out exactly what the best size is. So
yeah. And so like what you're talking about, just to unpack a little bit of a term there is, you know, that peak demand, in Ontario, for example, we would look at your peak demand and try and have battery system that can handle 2 hours of that peak demand, because we try to hit those predicted peaks on the grid, which are in 2-hour windows, right, Willie? So we can carry their exactly load of the entire site for 2 hours. So that's like in that example there. But if you're in California and you're doing solar, it's a little bit of a different calculation. So I guess it's a long answer to that question to the individual that asked that one.
No, I think that's great. And I know we have so many questions, and I just want to remind attendees that both presenters and their team will get back in touch with you if we do not hit on your specific question. This question is one that actually came in a couple of different forms in the chat as well as the Q&A. If you have, for example, a 50 megawatt solar facility, what percentage of that load can be supplied by a battery system?
Well, I'll feel free to add in after I take this to start with. I would say to that question, I saw that one too. That Imperial Oil slide case study is kind of a starting point for that answer. So, you know, this is a massive 20 megawatt site. Your site that you're referencing is 2.5 times larger. But I guess I would say that it, you know, depending on your footprint and what space you have, you know, we can continue to put batteries on the site to take that load in a larger scaled version of this. We're working on some other customers with a battery solution that is for a site that's twice as large as this one. So I do think that, that's what you can do there. But if you're talking about I guess that's what the question was with the batteries. There was another question about generation for a larger site, but that would be my answer for the batteries.
And Willie, do you have anything you want to add to that before we move on?
I don't think so. I think Drew touched on most of it, and we can try to get some other questions in here.
I know we have so many to try to get through. I am going to stay with you for this one, Willie. And this is a question actually I'm quite interested in as well. What are the enabling policies that make certain markets more attractive?
So I think I'll give two quick examples, one for standalone storage and one for solar plus storage. Standalone storage, an example right now is Connecticut is rolling out an incentive program where there is an incentive provided for each kilowatt hour of battery installed. So if you buy 1,000 megawatt hours or 1,000 kilowatt hours of battery, you're getting a kickback of say $100 per kilowatt hour. So by reducing the upfront CapEx of some assets, that can make more business cases pencil. So that's one type of incentive. Another one from the solar side is, I'm thinking of one in Massachusetts where for certain solar programs to get effectively a REC value, but a kickback from what's called the SMART program, you're required to have a battery alongside paired with the solar asset. So that's another mechanism that regulators can use to incentivize battery storage. So two quick examples. There's more in different states, but that should give a sense of what's out there.
No, that's great. And I appreciate you just giving us a couple of examples. I know that you could probably go state by state and talk about other options. But this next question, I know we're running through these as quickly as we can as more and more come in. What software actually manages the tricky part of the demand response, when to buy and when to use?
I would take that a little bit further even and say, yeah, you should answer the software part, but I want to just expand that question slightly. So there's the DR events, the demand response events, but I think even more sophisticated than that is looking at how to take advantage of these peak predicting events that are going on the grid and automatically managing and toggling over to the battery and the Enel X software. And I can't speak to, broadly, so we can't be vendor agnostic when we answer this question because we're going to talk about our own software. But we have, our software does this really well. And I think, Willie, you probably can speak to it more familiarly than I can. But I just wanted to broaden that question to how do we manage the battery asset for its various uses versus just demand response?
Yeah, it's a huge question. And it's like the main value add that a battery management provider has. So I guess the best thing I can do is describe that we have constant communications between battery, solar, meter data on site. We have large forecasting tools to look at weather, look at previous demand data, understand what we think will happen in the future, and update our battery optimization strategy accordingly based on all this real-time information. So there's a lot of forecasting, historical analysis to form our expectation for the future to optimize the results. So it's a very complicated thing that is hard to do, and that is the main value add and enables us to look at all these value streams at the same time. So there's a lot more there, but that's a quick look.
Which is great. And I know we are almost at the top of the hour, and I'm actually going to give the floor to Drew and Willie just one more time. If anybody attending wants to contact you, what's the best way to go about that? Is it LinkedIn? Is it email, or both?
Yeah, great. Thank you. I appreciate that. And we appreciate the opportunity working with you all at E&E. The best way to get in touch with us, I see a lot of questions here about demand response, potential on-site projects, and questions about the battery solution. I will, we'll be downloading those, and we will get in touch with you individually on some of those inquiries. I appreciate the the questions. The best way to, if you want to just take that question over to an email directly to me or to Willie, or both, feel free to do so. I think if you're more comfortable with LinkedIn, go for it. I think just getting, we're going to end up in email if we have a good conversation anyway. So if you want to start there, that would be great.
Well, that sounds good.
Yeah, same preferences as Drew, so it's great.
I figured as much. So I do want to thank you, Drew and Willie, for all the time you put in today's presentation. Thank you for providing the slide deck as well for all of our attendees. As much as we would love to stay on and answer all 40+ questions that have come in, I know that everyone has very busy schedules, but as Drew alluded to, they will get back in touch with every single person who submitted a question today. So thank you for being with us this afternoon, this morning, or this evening, wherever you are. And at this point, I'm going to conclude today's webinar. Have a wonderful day, everyone.